Thompson is a certified financial planner working at Cerity Partners, a full-service wealth management firm headquartered in New York City. Eric has over 10 years of experience in working with high net worth and ultra high net worth families on their complex financial needs. Eric specializes in working with technology employees and entrepreneurs with equity compensation and leads the firm's next generation practice focused on millennial clientele. At his prior firm, Eric led educational sessions on cryptocurrencies and blockchain technology, and currently strives to bridge the traditional financial ecosystem with the burgeoning decentralized financial landscape. And right now, he's going to explain how.
So just to highlight at the top that this presentation is not an endorsement of any custodian, coin, or investment, and all of these thoughts are of my own and not a representation of my firm. Now, with that being said, I'll take you back to July 2020 when I received a call from an 87-year-old client, a wonderfully kind older gentleman that's been getting spammy mailers talking about gold and some of the opportunities that are arising. And he never took advantage of these opportunities, but he started getting more mailers that were talking about Bitcoin and Ethereum being interesting opportunities. So he gives me a call and says, can you add this to my portfolio? Which you say, there's no real product out there or a way to integrate this into your portfolio. He says, okay, can you open an account or a wallet, whatever this is, in order to really gain access? And I mentioned, we don't really have that type of infrastructure built out yet within the traditional system. So, we can try and assist and get you there, and this leads to more and more questions and really confusion on his part that, we get to a place of, what are these coins, what do they represent, and how do we really make an impact in trying to get into these investments? And I had to sit back and explain what these coins represent, how we value them, and I'm fiercely reminded that we really have a long way to go. So today I'm here to discuss my experiences bridging the traditional financial ecosystem along with the decentralized finance that is burgeoning today. I'm not sharing anything earth-shattering, but really summarizing the conversations and the beliefs within the legacy financial ecosystem and the conversations that we're having amongst the traditional financial ecosystem as well as amongst high net worth and ultra high net worth clientele. So my role as an advisor at a holistic registered investment advisory firm addresses the multifaceted world of personal finance with key focuses on investments, taxes, and estate planning. So within each of these segments, I'll be highlighting their importance, how decentralized finance does or doesn't currently fit into that ecosystem, and killer app opportunities or really areas that are ripe for disruption, where development is ongoing and is ultimately needed for greater institutional adoption. So with that, I'll start off with investments. So the importance here is obviously that capital and credit are the lifeblood of our economy. Growing blockchain technology will not only require investing capital to bring this world to fruition, but also start requiring that this technology needs to start acting like a worthwhile investment. Not the extremely volatile meme coins that we've seen, but truly have some sustainable growth, cash flows, distributing earnings and income. From that standpoint, we don't want to mimic the vaporware of the initial coin offering boom of 2017, 2018, the meme coins with no calculable value, nor the roadmaps of the 2021 run-up in NFTs, where value was simply generated based off of additional artwork that would be sent out to you to try and rationalize the value today. So what I see as being needed is more so a skeuomorphic product design that mimics traditional financial infrastructure. New technology and new products that really mimic things that we're comfortable with and we trust today. An example of this, I'll touch upon, is assets that provide income or dividends. Now, think Ethereum's current proof-of-stake model. There's yield generated as a function of transaction fees, burn rates, the amount of ETH being staked, and this really fits into the world of distributing these earnings similar to a large cap value manager focused on dividend strategies, or a fixed income trader really focused on yield. Mimicking these things which already exist within our ecosystem will encourage and really grow the opportunities within this space and really push and drive potential investment. Now, there's a reason so many venture capital companies and capital allocators poured money into custodians like Coinbase and FTX in recent history. They can value what transaction fees are, they can forecast future run rates, and they simply don't grasp how FTX's coin FTT really played into the whole picture and kind of led to some of the debacle that we saw and experienced. Similarly, asset prices should have some tangible value related to them, not simply the greater fool theory. Jumping into a new coin or a new NFT intellectual property needs to have sound logic and an investment thesis. The longer higher volatile assets of no value gain adoption for no discernible reason other than a to the moon mentality, the longer it's really going to take to get institutional dollars flowing into this space and gain the trust necessary to really grow it. So some of the killer app opportunities here that I see are tokenization or tokenized assets. Tokens representing a share of a true asset, whether it be land, real estate, antiques, artwork, bringing these goods online and having their value assessed in a market in real time will unlock exceptional value for the holders and those looking to diversify beyond their basic investment portfolios. Additionally, being able to collateralize these goods for lending or borrowing purposes unlocks additional value creation in our economy. No longer needing to sell an entire piece of artwork in order to gain some monetary value from it, you can sell a partial share, lend based on it, and that adds money to our economic system. Similarly, other killer apps here are going to be Bitcoin or Ethereum ETFs. A Bitcoin ETF providing gold-like functionality to retail and institutional investors, being able to really implement it in a client portfolio. Bitcoin has had a number of use cases and product use cases from digital currency for everyday transactions, think the Lightning Network, to most recently Ordinals, their NFT network. But I believe that the most lasting use case for broad-scale adoption is really the long-term store of value case. Challenging gold in this arena has legs and is an actual area of conversation that's ongoing on a regular basis within the traditional financial ecosystem. Similarly, an Ethereum ETF, or something that lets clients hold ETH equivalent and generate yield within their true investment portfolio, whether it be a brokerage account or their 401k, this technology forward holding could provide meaningful value to investors and also unlock a substantial amount of capital that could really rapidly expand development within this space. So moving on beyond investments is now going to be taxes. If capital is the lifeblood of the economy, taxes are the lifeblood of the state. In traditional finance, taxes, we tend to focus on them in two important ways. It's going to be policy incentivization and decentivization. Decentivization being something like Bogovian taxes or cigarette taxes, something which inhibits you from a certain product or activity. Or incentivization, like long-term capital gains rates, something which incentivizes or motivates an individual to hold an investment longer term. The other way that we heavily think about it is really strategizing. While it's everyone's duty to pay their taxes, the worst kept secret of the financial industry is a strong focus on tax deferral and tax minimization. Mastering the tax code to reduce taxes and thus maximize returns over time is paramount in our industry. After all, it's not what you make, but what you keep that's important. So where does blockchain and all this funnel in? Well, policy is going to be really important here. And what's holding it back is Washington. Because a lack of clarity in policy becomes a significant roadblock, while creating clear and concise tax policy is going to be pivotal to broader adoption and trust. Uncertainty leads to volatility. Whenever there's instability, like we've seen this year from the stresses of the banking sector to the most recent debt ceiling debates, a lack of certainty about the future makes it increasingly difficult to plan, start, or grow a business. Now the alternative is true. Clear policy, guidance, and regulation, and I get it, it's at odds with the libertarian ethos of the crypto community. It does help instill the structures upon which innovation thrives. So with that, I want to give a shout out to Representative Tom Emmer of Minnesota's 6th District for being a leading voice in this endeavor, really trying to drive home policy and clear regulation in this area. Now, the killer app opportunity within the tax space is relatively broad, but it's going to be more so blockchain-based payments platforms. Now, while it may have its flaws, it can really improve the lives of everyday people, corporate entities, and governments. For everyday users, instant settlement of cash can really remove fees and hold times that exist within the legacy infrastructure, that's tied to checks, overnight transfers, and wires. For companies, smart contracts can automate payment processes or code contractual obligations that can really help them protect themselves. And for the government, traceability is going to be key here and pivotal for audit purposes from a regulatory standpoint and compliance from a tax payment perspective. So the last area I'm going to touch upon here is going to be estate planning. Now, why is it important here? Nothing is certain in life but death and taxes. I'll give the credit to Benny Franklin for that one. And he notes that, taxes are always going to be inevitable, as will death. While we focus so often on what happens to us today and tomorrow, there's an entire focus of the traditional financial industry that really focuses on what happens when we're no longer here. Rules surrounding transfer of property is as old as human civilization. The traditional financial world focuses on ensuring that these transfers meet the wishes of the deceased, as well as strategizing on how to minimize estate taxes, because it always comes back to taxes. So where does blockchain come in? All right, I'll paint a picture here. Digitally, of course. You create a high-end digital art series. Let's call them fidenzas for sake of argument. You own the algorithm that created these pieces, sold the original series of artworks, and receive a percentage royalty on every future sale. What makes blockchain technology so interesting from an estate planning perspective is the ability to maintain rights and ownership of artwork or creative endeavors after sale and have that automated and coded into the process. Provenance, or the history of that ownership, is maintained, and future income generation can be retained by an individual, then an estate, and then a beneficiary. This is extremely interesting and a huge value unlock really within the entire ecosystem that we experience today. Non-fungible tokens go beyond the Bored Apes or CryptoPunks and provide a meaningful innovation for creatives on the content creation side and disrupt title companies and record keepers like municipalities on the other. So the killer app here is really in the NFT space trying to generate some high level of value creation. But what's holding it back? Now, from my standpoint, I think it's some level of centralization. A few companies really controlling many of the creative ecosystems and industries that we have in the United States. So Choke Point Capitalism, a book by Cory Doctorow and Rebecca Giblin, fantastic if you can go pick it up, highlights that high-end art auctions are heavily controlled by 3 companies. 5 major movie studios control over 75% of their respective industry. 5 publishing houses control 80% of the book market, and 4 major record labels control 85% of the music industry. And this is all to say that making progress on the use of smart contracts for royalties for creatives or coding rights to digitize assets will require some level of input and buy-in from these companies. Being able to work alongside them, whether it be as a startup that is trying to show them the efficiencies that can be built within this space, or really trying to work alongside and develop from the ground up a grassroots movement to really work alongside these creatives is going to be an important area here. So in closing, I'm going to go to physics. The second law of thermodynamics posits that systems move towards entropy, and I believe this to be true within our capitalist financial system. Once reliant on just a few families and banks to keep the records of our financial lives, this process has grown increasingly decentralized. Similarly, the speed at which we can transact and settle funds, also known as the velocity of money, continues to increase. Last, the assets that we will be able to finance, borrow on, and lend from in the future will continue to increase as derivatives and tokenization make this possible. So the more decentralized the system, the more actors within that system, and the more movement of money we have, the better our economy functions. Blockchain will play a pivotal role within this process, and over this overarching thesis is the reason I'm confident it's not an if, but when the greater financial ecosystem will be adopting blockchain technology, and it's why everyone in this room, from developers to early adopters, will be on the forefront. Thank you.